Hi, welcome to Coffee with Katie. Coffee with Katie is an initiative that I started to help simplify the financial conversation. I'm Katie Brown. I'm a certified financial planner, and I have had the privilege of serving families for nearly 20 years figure out their financial landscape. So I decided to do a 3-part series on investing basics. Hopefully you saw my last video where I talked about reasons why to invest and also laying the groundwork for investing. This one, I'm going to dive into different types of investments. So let's start with kind of high level, the difference between a stock and a bond. Here's a quick side-by-side comparison. So a stock is essentially you're purchasing equity ownership in a company and you're hoping to grow with that company. And if that company does well over time, then what you paid for that share, say you paid $10 and it goes up to 15, that's your capital appreciation. And that's the goal of a stock, to have that price go up and maybe to collect a dividend. That's the income distribution along the way. Now, however, if the company doesn't do as well and it loses money, then your stock value can go down. So you are not guaranteed to get that $10 back that you put in. So that's a quick overview of a stock. A bond is a little bit different. A bond is where you are lending money either to a company or municipality or even the US government if you buy government bonds. And essentially what you're doing is you are lending them money and then they are going to pay you back. They will pay that principal back and interest along the way for the right to borrow that money. Now, assuming that the company does not go into bankruptcy, which most of them don't, but you have to be careful of the quality of bonds you're purchasing. But assuming that they don't, then you're guaranteed to get that principal back. So if you buy a $1,000 bond, you're guaranteed to get that $1,000 back plus the interest. So that's why bonds are often considered more stable than stocks, because theoretically you should get your money back, whereas a stock, you may not get your money back. That's not guaranteed. But the stock can grow with the company. And so there's a higher probability on a stock that you could earn more than that interest level that you might get on a bond. And so that you can participate further in the growth. So that's kind of high level the difference. Now, something that I'd like to go a little bit deeper into stocks for a minute. There are a number of different ways that you can break stocks up. So this is one way, and you might hear about this different classes. So you could have a large cap stock. Essentially, that's where the value of the company is typically over about $10 billion or more. So think of things like Amazon, Apple, Johnson & Johnson. Those are all large cap companies. Then you have a mid cap company. And so their value might be somewhere between 1 billion and 10 billion. Or you could have a smaller cap company. So a smaller capitalization is usually somewhere about 300 million to $1 billion of value for that company. So that might be something like Red Robin or Bed Bath & Beyond. Those are smaller companies. So those are types of classes of stock that you could have. And then you could get more granular and get into sectors. So technology companies, financial companies, consumer goods. So you might hear some of those phrases thrown out there for different types of stocks. On the bond side, as I mentioned, bonds can be corporate bonds. There's a number of different types of bonds that you could have. And so they could be government bonds, and each one kind of has its own taxing structure as well. So if you have a government bond, then you don't typically pay state income taxes on that interest that you receive from that. If you have a municipal bond, then you don't typically pay federal income taxes on the interest that you receive, and maybe not state if you buy a bond in the state that you live. So Pennsylvania, for instance, if I held a Pennsylvania municipal bond, I would not pay taxes on the interest that I receive from that bond. Or you could have corporate bonds. Now, typically corporate bonds might pay you a little bit more interest because you don't have the tax advantages of some of the other ones. And then other things to be aware of when it comes to bonds is the quality. So whether or not they are investment grade, you may hear that term, and you can look up the different ratings of the bonds. So typically an investment grade bond, it starts at AAA is the highest quality bond, then AA, then single A, then triple B. And anything below triple B then is considered below investment grade, or they might be considered higher yield bonds because theoretically, if you're taking on more risk, then their interest rate that they pay you should be higher. So I hope that's helpful for an overview of stocks and bonds. Really quickly, just wanted to point out what a mutual fund is or an exchange traded fund. In both of those cases, essentially the fund manager is pooling investor money together and then buying a basket of stocks or a basket of bonds, or maybe a combination of both. And so you can buy into the mutual fund and have a lot of diversification within that single purchase. And that's what a mutual fund is that pooled investment put together so that you can get access to a number of different funds within there. But before you buy a mutual fund or even exchange traded fund, you want to make sure that you understand the strategy for that particular fund and the expenses to make sure that it is a good fit for your portfolio. We'll talk about asset allocation next. Thank you so much for tuning in to this Coffee with Katie. I hope this gave you a better understanding of stocks and bonds, high level, the different types of investments. And I will look forward to hopefully connecting with you again soon as we talk about asset allocation in the next video. If you have any questions or would like to reach out, please feel free to do so at kbrown@nortonbrownfw.com.